Okay, everybody. My name is Risley Sams. We'll be getting started here in about 1 minute. I want to say thanks, everyone, for checking in. Looks like we've got quite a few participants here today. Thank you very much for joining us. Again, my name is Risley Sams. This webinar is being recorded. I am the CEO of RHS Financial, and I want to welcome you to our very exciting masterclass and webinar on something we all hate, taxes. And we are going to get started here in just one moment. Let's see, close this out here. I am going to be running this whole webinar myself, so please bear with me if I'm changing slides and whatnot, as we are working under COVID-19 restrictions, and I'm the only one here. So please bear with me with that. And I'm going to go ahead and get started. Again, my name is Risley Sams. I'm the CEO of RHS Financial. I want to welcome you to our Masterclass webinar on the 3 year-end tax moves for 2020. My firm, RHS Financial, we're a wealth management firm in San Francisco. Many of you who have tuned in today know us. We help business owners and tech executives think bigger about their personal finances, and we help them invest with purpose. We also help them try to make the right tax moves to pay the least amount of taxes possible, because the more you keep, the better off you are. I want to stress that we are financial advisors, but we are not tax professionals. Being a certified financial planner and a certified private wealth advisor, we know lots about taxes, how to minimize them, but we do want to make sure that you consult your tax professional before making any decisions today regarding your tax situation. I first want to let you know we have a few housekeeping issues here that I want to let you know about. One is that if you look at the bottom of your screen, you can ask me a question through chat. You can also ask me a question through, I would prefer it if you did it through Q&A down here below. But before we get started, if anybody would just like to let me know where they're from, why they're here through chat, I'd appreciate it. It would be kind of fun to get things started right there. Also, want to let you know that this webinar is basically put into 3 parts. One, I'm going to talk to you about why we think taxes are going to be going up in the future here in the next couple of years. So why you want to take advantage of some of the tax provisions today and the current low rates. Also, there are a few things different because of COVID-19 for 2020 that we won't normally get to have in other years. So I'm also going to let you know about that. Then we're going to actually go through all 3 of the year-end tax moves and talk some more in depth and some less in depth of what you can do. And finally, I'm going to end with a Q&A session. So with that, let's see here. We had a couple of people say, Randy's here. He's in from Texas. Thank you, Randy. And want to welcome everybody aboard. We got quite a few people in for this webinar, so thank you very much for joining again. And we have a couple Q&A questions here. As also Randy and a few others have said hello. Thanks for joining in. All right, let's get started. I'm going to shift here. I'm going to shrink a little bit. This is a smaller me to go through all our slides. Again, welcome. We're going to talk about 3 big picture year-end tax moves you can make for 2020. We believe taxes are likely to increase in future years, so here's 3 things you can do today to at least change your tax situation or take advantage of things. Well, let's start with 2020. 2020 was and is a year like no other. Let's do a quick recap. Obviously, COVID-19 shut down the economy in March. We had very strong shelter-in-place orders here. Most of my clients are from California. We all know that we were stuck working from home for many, many months. As a consequence, the U.S. stock market tumbled. Obviously, markets don't like not knowing what's going on, and certainly COVID situation was one of those. We had unprecedented volatility during that time. Stock market went down faster than it did during the 1929 crash. As a consequence, the government kind of knew that by shutting down the economy, that they would also need to quickly develop a coronavirus aid relief package, which they passed, which was called the Coronavirus Aid Relief and Economic Security Act, also known as the CARES Act. It was passed on March 27th, and believe it or not, the amount of the stimulus package was $2.2 trillion, which was more than 10% of the United States gross domestic product. It was a massive, massive, massive relief package. So despite a 30% contraction in Q2 gross domestic product, and then as we saw, as we kind of reopened the economy some in June and July, we saw a 38% growth in Q3 stock market, or excuse me, in GDP, which coincided with a massive stock market rally where the stock market basically recovered almost all of its losses in very short order. Again, massive volatility in the stock market. We all remember it. It wasn't all that long ago, and it's kind of hard to believe that we're back up to where we are. Some people may dispute this, but Joe Biden won the election in November. He's now the president-elect, as it looks to be. Interestingly enough, however, the down ballot races, meaning Senate races or Senate and in Congress, we actually had a bit of a red wave. So a lot of Republicans actually won the down ballot races. Finally, just the other day, the Dow broke 30K in the stock market. So we have actually seen record highs in the stock market as of basically just a few days ago on November 24th. Crazy year. All in all, it's a crazy year. So I thought about what was going on here when I titled this slide, and I remember in the Bible, basically, Jesus said, "Render unto Caesar the things that are Caesar's." And I believe that the government, much like back in the times of Rome, when Jesus was talking about paying taxes to Caesar, we're going to be paying taxes to the government. Stimulus comes with a price tag, and I think it's going to be a very, very hefty price tag. So we saw unprecedented government spending in 2020. The CARES Act was $2.2 trillion. To put that in perspective, the TARP, Troubled Asset Relief Program back in 2009 that got us out of the first financial crisis was about $750 billion. So it was almost 3 times the size of that program. And to kind of put that into perspective, back then, that program caused the government to do 9.5% deficit spending. This year has caused 17.9% deficit spending, meaning the government is spending 79% more money than it's bringing in taxes this year. And on top of that, next year, the estimate is to be another 9% over that in deficit spending. So, one, we're seeing the government spending more money than it's ever spent before. And we actually see more potential stimulus on the table. They're talking about doing another between 1.5 and 2.3 trillion dollar stimulus bill again, even before year's end. So there's going to be a lot of stimulus on the table, and that stimulus costs money. If anybody looked at the Biden proposed tax plan, we found it was very aggressive. So the tax plan that Biden put together before he got elected was on the internet. Many of us read it. He wants to basically go back to all the Obama era rates and also raise taxes on corporations. I have a quick slide on that to show you, but they're very aggressive, meaning we will pay, if he can get those to be passed, which may be difficult, we'll be paying higher rates in the future. So no matter what, taxes are likely to rise, but we believe if we continue to have divided government, it'll probably be no less than 2 years out before we see those. But we also do want you to take advantage of current 2020 tax rate and CARE Act provisions. So that's one of the main thrusts of this entire webinar. So again, taxes are likely moving higher. It'll probably be after 2021. So we currently have the Tax Cuts and Jobs Act rates. Okay, those were passed in 2017 and came into effect in 2018 under the Trump administration. They are scheduled to sunset in 2026. However, as I mentioned, it looks like we have divided government. There's going to be a runoff election in Georgia. I'll talk a little bit about that, maybe more in the Q&A session. But if we remain in divided government, meaning the presidency's a Democrat, that Congress is Democrat, but the Senate remains Republican, it's going to be difficult to get those provisions sunsetted. One of the very interesting things that Biden proposed was he actually proposed eliminating the cost basis at the step up at death. So when someone passes away, usually their cost basis gets stepped up to their date of death for both property and stocks in taxable accounts. He's saying eliminating and doing away with that. That would be a windfall for the government for sure. Cap gains will be higher. If you actually look on the right-hand side in the graph, I say that the current top rate is 20%, but Biden has proposed for anybody earning an income over $1 million, they will pay the full top tax rate of 39.6%. And corporate tax rates will go from 21% top rate to 28% top rate. Anyway, before I move on to the next one, I just wanted to put out a quick little poll and find out who here, who on the call, whether you plan to itemize your deductions or you just take the standard deduction this year. So the standard deduction is $24,800 this year versus itemizing. So far, we've got quite a few people figuring out. Right now, we've got it at about 50% to 50%. So 66% have voted, and 50% of people are going to itemize this year, and the other 50% are doing standard deductions. Very cool. Thank you very much for doing that and sharing. I'm going to share the results. And so again, 50% are itemizing, 50% are doing standard deductions. So that brings us on to our 3-year end strategies. Now I want to quickly just look at here and just see if anybody, nope, no one else. We've got a call in from Germany. That's very cool. Or someone who's here from Germany. Thank you very much. And we got some folks in from Minnesota and Canby, California. Thank you very much. Hold on a second. I'm going to get out of this here. All right. So now moving on to our 3 year-end strategies. This is the meat of the presentation. And again, we are just want to make sure that you take advantage of current low rates and, of course, some of the advantages in 2020. So there are 3 year-end strategies. And I do want to say not all will work for you in particular. In fact, some of this just won't even work for any of you, but we want to make sure you at least know about them. So you can use one or some in combination, but most importantly is we just want to make sure that you know you can take advantage of current rates that we know we have. Now, the first 2, I think, are the most important to you and saving on your taxes, and that is tax loss harvesting. Tax loss harvesting allows you to harvest losses that you have in 2020 and take gains in them in your taxable accounts. And what I mean by that is you can just save money on your taxes and rebalance your portfolio by being strategic about the way you take your losses and offset your gains. Almost everybody this year is going to have some gains and losses in their accounts. We can also, some people may choose to exercise some of their options this year, their stock options this year, and lower concentrated stock positions, perhaps in a company that they work for. The other strategy is taking your IRA and converting some of that into a Roth IRA. In particular this year, some people have lost their jobs, so they're going to have a lower income. They can convert some of their IRA to a tax-free Roth. Similarly, many of our clients and people we know who are older, age 70 and a half or above, who are taking their RMDs, will have lower incomes because this year they didn't have to take an RMD. And finally, strategic gifting. And I'm going to go into strategic gifting, so we won't talk about it here, but gifting and giving charitable donations may actually be able to do more this year than you have in previous years. So let's talk a little bit about tax loss harvesting. Obviously, this was a very volatile year in the stock market. Many investors took losses earlier in the years or have losses on their books, and they can take them to offset their gains in their portfolio. This is an opportunity to rebalance away from low basis stock positions, something you might have bought a long time ago, and you have some losses, so you can offset those. And other people can exercise or sell their options. And let's just remember one thing though, tax loss harvesting only works in taxable accounts and it does not work in your retirement accounts. Make sure you don't mix the two. That's very important. I'm going to show you a couple of examples. The first one I'm going to show you is doing tax loss harvesting when you have long-term capital gains, meaning you have lower cap. This is when you have held a stock or a fund for over a year. You must realize the gains and losses in the same year, meaning you have to do it all by the end of this year. So, for example, in this example, we would sell stock A that has a $50,000 gain. If you multiply that times the 15% tax rate, you would get $7,500. You'd have to pay $7,500 in tax. But if you sold stock B and took a $25,000 loss, you can see here in the calculation that your $25,000 loss plus your $50,000 gain equals a net gain of only $25,000. You then take that $25,000 net gain, multiply that by your 15% tax, you then only pay $3,750 in tax. Okay, so you've lowered your tax gain. You actually have not changed the value of your overall portfolio because you took your gain and you took your loss, and now you can take the proceeds from the two and rebalance your portfolio. This is very, very helpful for going into the next year if you think that there's opportunities in different parts of your portfolio and rebalancing. Again, we've been doing this for our clients this year, and we're talking to our clients about this so far before the end of the year. The next thing is looking at an example of using a $25,000 tax loss to actually get a tax break this year and in future years. So this would be if it was something that you did this year. This is all short-term capital gains. So you'll see when you take short-term capital gains, you actually pay your tax, your ordinary income tax rate. So anything you've held for under a year, right? So you could sell an investment that's underperforming and then use that loss to reduce your taxable capital gains. In this example, investment B has a loss of $25,000. You use that loss to offset your $7,000 capital gain, and then you can apply $3,000 to reduce your ordinary income this year, as well as you then also get to apply $2,000 towards your future gains on income, which gives you actually a total of $8,050 tax savings. And then you can also reinvest the money into a different security and rebalance. Again, I am recording this webinar so you can watch it again and look at this again and see the slides. But the whole idea is even though you have a position in a loss, it doesn't mean you have to sit on that loss. You can actually use it to your advantage to pay less in taxes going forward. And I think that's the most important thing to understand. Tax loss harvesting can be beneficial, especially in a volatile year like 2020. Moving on to the next strategy, and I think this one is also this is one that I think is going to be particularly good for a lot of people in 2020. And that is converting IRA money to tax-free Roth IRA money. Now, IRA money is tax deferred, meaning at some point when you turn age 72, the government is going to require you to take that money out. You'll have to take what's called a required minimum distribution. Many of the people who are actually watching this right now know this because they are taking their required minimum distributions. But this is a big opportunity this year. We're probably going to see, and it's one we don't want to miss. And there are two primary reasons for that. And this is that we've seen lots of people have lower incomes due to COVID-19 job losses. Someone, one or two spouses have lost their job because of COVID. They just will have a lower income this year. Maybe some people who are in sales who used to make a lot of money aren't making as much money this year. And then for seniors, this year, if you did not have to take a required minimum distribution. Now, all my clients know that. They haven't taken one this year. But many people didn't, so suddenly their income is going to be much lower. So some of the other reasons why you would want to do this, so that's why we may see lower incomes this year. And some of the reasons why you would want to do this is that if there's high deficit spending in the government, it means they're going to need to raise taxes in the future. And since required minimum distributions from IRAs are taxed at ordinary income rates, if rates go up in the future, when you take those required minimum distributions, you're going to be paying a higher percentage to do that. So tax-deferred investing will be less effective as distribution rates will be taxed at higher rates. But if you convert IRA to Roth IRA money now, where rates are lower, you can get tax-free growth for the rest of your life and pay no tax on future distributions, and you won't even be required to take the money out. And maybe you can even pass that on to your children or whoever you want to pass it on to if you don't use that Roth money. So I just want to remind you that Roth conversions are considered ordinary income by the IRS. They're subject to the IRS's progressive tax bracket system, and we're going to talk about that in a moment. Be careful not to move into a higher bracket than you would by estimating the new marginal tax bracket in future years. And I'm going to show you this. This is really important. But remember, we need to consult a tax professional before making any of these decisions, because in previous years before the 27 Tax Cuts and Jobs Act was passed, you could actually revert. If you did an Roth conversion, you could actually reverse that. You no longer are allowed to do that. So make sure if you do this correctly. So your estimated income determines the attractiveness of a Roth conversion. So what I want to just spend a moment or two looking at are these tax brackets. And you can see you want to use up the lower tax brackets first. So, and we're just going to use married couples in this example, but from 0 to 19,750, the tax rate is only 10%. From 19,000 to 80,000, it's only 12%. And then after 80,000 to 171,000, it's effectively 22%. So that's kind of the third tax bracket. Now, if you can keep you want to use up as much of these brackets as you possibly can. So that's what we're talking about when we want to do a Roth conversion. We want to go kind of right up to that border of that next bracket, but stay within that tax bracket. So let me give you an example. And when you think about how much you should convert, there are two basic determinants. One, the effects on your tax rate, i.e. your bracket. Again, using as much of that tax bracket you can, but not bumping into the next one, because then you're just going to end up paying more tax. And then finally, your ability to pay the tax on the conversion amount, right? You can convert some of your IRA money, but if you can't afford to do it, it doesn't make any sense to do it, right? So let's talk about a married couple with one spouse who lost his job during COVID-19. Their reduced income for 2020 now is $50,000 total with all their income, some of their income from their portfolio, thus the $24,000 standard deduction, which means their income for 2020 will be only $26,000, right? They can convert $54,000 to a Roth IRA and stay within that 12% bracket, meaning go up to 80,000, not bump up into the 22% bracket. So 80,000 minus 26,000 equals 54,000. Then the tax cost of this conversion would be 54,000 times 12% equals $6,480. So it cost them $6,480 to convert $54,000 to tax-free money that can grow in the future. I think it would be very, very worthwhile to do that. And anyways, so that this is just an opportunity. So they take full advantage of that 12% tax bracket. So Sam James just questioned me. He said, he asked me if you go into the next bracket, your entire amount is taxed at that bracket, and the answer is yes. So that's why you don't want to bump up into the next bracket, right? So you want to stay in that bracket. Thank you for that question. So in our second example, we have a retired married couple who did not take their RMDs in 2020. Meaning, again, if you're used to taking your RMDs in 2020, the CARES Act allowed a provision, and they said, hey, you don't need to take the money out of your IRAs. The government wanted to let you not have to take it out in a bad year. That was part of one of the relief acts. So they only have $40,000 in taxable Social Security income in 2020. So their combined required minimum distributions, if they both took money out of their IRAs, would have been $90,000. So their normal income would have been $90,000 plus the $40,000 Social Security income, equaling $130,000. But then they take out their $24,000 standard deduction for a grand total of $106,000. But in this year, since they only have reduced income of $40,000 minus their $24,000 in standard deductions, now their income is only $16,000 for this year, right? They can convert up to $64,000 to a Roth IRA and still stay in that 12% bracket and not bump themselves up into the 22% bracket. The cost of this conversion would be $64,000 times 12% of $7,680. So again, this would be huge for them. They would be able to convert $64,000 into Roth IRA tax-free money into the future. So this is a big bonus for them. And again, you know, you got to consult your tax professionals. They know more about your particular tax situation. But if this is a great opportunity for them because they didn't have to convert or they didn't have to do their required minimum distributions this year. So that is, I think, a very good opportunity for people, and we can talk more about this in the Q&A. This is a very prime example. I'm not saying this is going to be for everyone. So now let's talk a little bit about the third and final strategy. And this, by the way, is something that high net worth families have been doing for years. And that is strategic gifting. It's been used by high net worth families for decades. Anybody can use these strategies, though. This is not exclusive to anybody. And I think when we talk about these strategies, it's less about you saving money on taxes and more about what you can do for others, either your family or charities. So this is much more charitable and family gifting focused than it is necessarily you saving on taxes. So you can and you've always been able to do a qualified charitable cash deduction out of your IRA, meaning you can take money out of your IRA and give it directly. They just do the distribution straight to charity, meaning it doesn't come to you at all. It goes straight to a charity. This year, during the CARES Act, we also have if you're doing the standard deduction, the government now this year allows you to do a straight up $300 charitable deduction above the line to any charity. Again, this is not if you itemize, this is if you do a standard deduction. You also have the annual exclusion gifts of $15,000 to anybody, meaning you can, from a taxable account, gift $15,000 to anybody you want, whether that's a child, an uncle, a relative. And that money gets taken out of your estate. Now, this is what ultra high net worth people have been doing for years. They do this with private stock, et cetera, et cetera. Also, what very few people know about is you can make direct payments of tuition and medical expenses directly to either the school or the hospital to pay tuition or medical expenses for somebody else. You can also this is one that's a little more complex, but if there are large gifts going on, you may want to try to complete these large gifts before tax rates go up in the future. And I'll go over each one of these. So CARES Act changes. Again, qualified charitable distributions are still allowed in 2020, but they're a little less effective than they have been in the past. So again, you can still do a qualified charitable distribution of up to $100,000 from your IRA to a qualified charity from your IRA. The direct distribution would not show up as taxable income to the individual. However, since required minimum distributions have been suspended for 2020, these distributions won't offset any required minimum distributions. Again, you can be very charitable, but it won't offset any RMD income. There is a new above the line $300 deduction for charitable contributions. I mentioned that earlier. This is just don't forget it. If you give $300 to charity, make sure you take that deduction this year, or tell your tax advisor to make sure they take that above the line deduction this year, because you'll get that over and above your standard deduction on top of it. So the CARES Act this year allows for cash gifts to most public charities of up to 100% of your gross AGI this year. That's your adjusted gross income. Meaning, if, let's say you sold a company, or you sold a lot of shares of your company this year, and you were feeling extremely generous, this would be a good year to donate directly to the charities of cash, because, and again, this is cash only, because you can deduct up to 100% of your AGI this year. Normally, they only allow up to 60% of your AGI. So you can do it. It's preferred for high earners in 2020. And again, these are cash gifts. Now, many of you have donor advised funds. None of these can go to donor advised funds. This is separate from donor advised funds. Donor advised funds are generally very, very advantageous. But in 2020, all these provisions tend to be more for direct cash gifts. Now, there's strategic gifting. Now, this is what I was talking about. And this has, again, been done for high earners and people with ultra high net worth for a very, very long time. The annual exclusion gift of $15,000. Again, you can gift anybody you want $15,000 per person, meaning a couple could give actually $30,000 to anyone. We also call these as lifetime transfers, and this money goes out of your estate. So it reduces the size of the estate. And generally, obviously, this tends to go from parents to children, intergenerational wealth transfer. Also, again, a reminder, you can pay tuition and medical expenses to anyone as long as the money goes directly to paying either the university, the school, or the medical provider, right? And finally, if taxes are expected to go up, many people who have really large gifts, i.e. private stock and intergenerational transfer of things like private stocks or companies, you may want to fast forward and accelerate the completion of that gift in the next few years, because if tax rates go up, it's just going to cost more money to do that in the future. So with that, I want to turn it over to Q&A. Thank you very much for listening to all these. This webinar has been recorded. I will make sure you'll get an email with a recording of this webinar, and if you want to review it, and feel free to schedule a time with me to talk over any of these. But I do have a few questions that were asked previously before the webinar starts, so I wanted to answer those questions. Todd asked, do I need to take my RMD out this year? In regular years, I don't need to take it it all, or once can I take it all in chunks? The answer is no one needs to take an RMD this year. You can take it in chunks if you want. She asked if I don't need to take, where would the best place to take money from? Yeah, your best place to take money from would not be from any IRAs this year. If you could take it from taxable accounts, that would probably be the best. And maybe the best thing to do is do some tax loss harvesting, like we talked at the beginning of, so you minimize your overall taxes when you take out that money. I had another question here from someone who is not yet 72, but is getting near that place. She's currently getting Social Security and part-time income from her portfolio. How should she be thinking about managing income source to keep your taxes at a minimum? Again, your best way to do that is do your tax loss harvesting here at the end of the year, perhaps so you minimize your overall taxes on that money that comes in this year and every year, which we do for our clients in general. Other way to keep there may be other ways outside to do that, but that's pretty much your best way, is to do some tax loss harvesting at the years, offsetting your gains with your losses. So the money that you do withdraw from your taxable portfolio, the taxes are minimized that you pay for on that. The other things, if you are getting part-time income, you may want to accelerate your income this year and probably next year, try to get more in this year. If rates go up in 2 years, for example, in 2022, and you're paying higher rates then, that may also help you minimize your tax burden. Let's see here. I've got a few texts. No. Let's see. I got a question about a minimum time money that the Roth has to stay, money has to stay in a Roth before tax-free withdrawal. Yes, it's 5 years. And then can I take money out of the Roth to pay taxes on money out of the standard IRA, right? Yes, you can take that. You can do whatever you want with that tax-free money on your Roth IRA. You can take it out at any time. You can take it all out in 1 year. I've had clients, put money into Roths and use that kind of as their vacation money in future years, where they were like, hey, that's tax-free money to me. I won't have to pay taxes on it. And so they feel that they, have more discretionary capability on that. Let's see, do we have any other questions? Let me check the chat box, see if there's any. Let's see here. Okay. Bumping up. Does that mean if I pay for my grandchildren with my IRA, I will not be taxed? No. I got a question here that says, does that mean if I pay for my grandchildren with my IRA, it will not be taxed? No. That is, if you take money out of your IRA, it will get taxed. Now, if you do like a qualified charitable distribution to a charity and it goes directly to the charity, it will not be taxed. So I hope that clears it up. That's like a qualified charitable distribution where it won't get taxed. Otherwise, so you can't pay for your grandchildren that way. Let's see. I got a question on tax harvesting. I purchased stock at 3 different times in separate lots. 2 purchases have gains. 1 has a loss. Can I sell the loss lot and use the loss against the gain from the other gains? Yes. The answer is yes. As long as they're all in the same type of account. As long as they're in taxable accounts, meaning like a brokerage account, and they're not in an IRA, yeah. If one's in an IRA and the other's in a taxable account, no, that doesn't work. Given expectation of higher taxes going forward, does it still make sense to contribute to a traditional Roth versus a 401k Roth? The answer is that one depends. I can, that's kind of a situation by situational basis. It kind of depends on what your current tax rate is on your income and how much of a tax break you want to get on your income. High earners, you want to get as many tax breaks as possible. So contributing to a traditional 401k is probably a really, really good thing. And we would probably recommend that you go back to doing that, contributing to your traditional versus your Roth. And maybe if there's a period of time when your income goes low, like let's say you took a sabbatical or you took some time off and you didn't earn any income for a year, then you might want to do a Roth conversion in that year and take some of that money that you put in your traditional 401k and convert it into a Roth. Does that make sense? Or I hope it does. Any other questions? These are some great questions, everybody. You're making me think, and I really appreciate that. I had a question. Any advice on 529s? There's really nothing. 529s are a little different, and there's nothing really in 2020 on 529s. So that's not really going to save you anything on your taxes. The only thing it does is it allows you to put money away tax deferred for, tax-free for your children. And I recommend you put that away, but that doesn't really change your tax situation in this year, if you understand what I'm saying. Any other questions? All right, I think we've come to all the questions. I certainly want to say, I'm just going to let you know, you're going to get some follow-up emails. A lot of the people who are on the call, I know. I'm actually going to reach out to you guys and try to get some feedback. This is our first Masterclass webinar. It's been super fun. I hope you enjoyed it. I hope you like some of the production values that we put into it. We really tried hard to make it a little different and more interesting than just a plain old slideshow. And definitely are glad you were here. Oh, we have one new one. There was a question about expected increase in capital gains is for above $1 million gains. No, it's for $1 million in income. And does that mean that less than 1 million gains will be 20% and there are no steps between 20 and 40? That's a really good question. And I don't want to answer, I want to answer that the best I can. I think it basically means is that if your adjusted gross income is over $1 million a year, you won't have long-term capital, you won't have capital gains rates. Anytime you sell something for capital gains, you will just pay ordinary income. That's the way I understand it, meaning you don't get cap gains. If you are in that fortunate place that you are making over $1 million a year in income, you will be taxed at 39.6%, which, by the way, this is all speculative. Depends if Biden gets in and gets his way. That's what he's talking about. So this is all proposed. This is not for sure, but if that's the case, that's the way it's going to be set up. Again, it's going to be based on $1 million. If you earn $1 million in that year and you sell a stock at a profit, you're going to pay 49. You're going to pay the highest income bracket, and that's 39.6%. Thanks, everybody. I really, really appreciate the time, and I hope it went well for you. I think we're going to end it here. And again, feel free to reach out. Most of you have my email and know how to get a hold of me, and you're going to get some follow-up emails as well. And appreciate the feedback. Thanks so much. Have a great day, and happy 2020.